As you learned in IM Financial Knowledge Level 1, there are many things you may invest in, such as stocks, bonds, real estate, collectibles, and precious metals. But what are these exactly? A share of stock is something you purchase that signifies ownership in a company. If you own a share of stock in a company, you are a shareholder. People buy stocks because they hope they will increase in value and they can make a profit on them when they are sold. This profit is called a capital gain. When you purchase a bond, you are loaning money to the bond seller in return for a fixed interest rate over a fixed period of time. While you hold a bond, you earn interest. Often, the bond pays interest twice a year or 4 times a year. At the end of the agreed-upon time period, the bond seller pays you back the money you lent to the firm in the form of a bond, your money plus the interest. Stock and bond mutual funds are groups of stocks or groups of bonds. Instead of buying a single stock, you can buy a share of a mutual fund, which contains a group of stocks. The groups of stocks owned by different mutual funds are often distinguished from each other in some way, such as industry or geography. For instance, you might decide to invest in a mutual fund of stocks in the healthcare industry because the population is growing older, or from another part of the world that is growing. Buying into many stocks or bonds through a mutual fund is known as diversification. Diversification is a tool to help manage risk. You've probably heard the saying, "Don't put all your eggs into one basket." If you did and dropped the basket, or if something happened to the basket, you would not have any eggs left to sell at the market because they would be broken or missing. By diversifying your investments, you are spreading your money or eggs throughout many baskets. That way, if something happens to one basket, you will still have other eggs left to sell and money left to your name.